The U.S. market is back near its February record high, but our guest does see challenges ahead, including trade deal deadlines or tariff deadlines, and also increasingly negative business sentiment, plus the conflict in the Middle East. There are investment opportunities, though, he says. We're joined by Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Great to see you.
Thank you. Good to be here.
It does feel like there's an anvil hanging over the market in terms of these tariffs. We don't know where that's going to go.
Given where valuations have climbed back to, I think particularly in the U.S., we need to ask ourselves, are we in a measurably better place today than we were in early April when the tariff story really first kicked off? And the answer to me is no. You mentioned the trade deal deadlines that are fast approaching. That'll be a major source of anxiety for investors, businesses, and consumers. Although the hard economic data is still coming in relatively strong, there are month over month more and more stories about increasingly negative anecdotes coming from businesses, Main Street to Wall Street. And third, you mentioned it off the top around the expanding conflict in the Middle East and how that's been a cause for concern that investors are having to digest again.
So there's a risk, or investors, I mean, the stocks are near record highs. So it looks like a lot of investors have decided, well, this tariff war won't be pleasant, but it won't be that destructive.
Our view is that it's been prudent to raise cash balances, both within our strategies and with our portfolios. It allows us to take advantage of opportunities as we feel volatility takes the reins again, and puts us in a good position to add value for our clients.
What about the oil market? I mean, if oil goes up, that's inflationary, both actually and also it's very visible.
Well, I think if I was on here last week, I would have told you that cheap oil prices is the cure to cheap oil prices. And it's been kind of a bit of a fiscal stimulus for consumers, given that a cheap oil is effectively like a tax cut for consumers, helps with spending elsewhere. And given the concerns over tariff increasing prices, that's been offered a bit of support for the market. With rising prices, that's more of a geopolitical shock. We're seeing today that prices have come down. We'll have to see how the conflict evolves.
You have been raising cash in your portfolios, trimming your exposure to stocks. Now, you say the U.S. equity risk premium has dropped. What does that mean, the equity risk premium? What does it tell you?
It's effectively how you're being compensated owning U.S. equities relative to a 10-year treasury. And you're right that the equity risk premium in the U.S. is down to around where it was in 2002. The last time we saw this kind of compression was in 2022, and we know how the market performed that year.
2022 was ugly for tech investors in particular,
We just feel that investors are not being compensated necessarily for the risks that are out there. It doesn't mean we're not finding value opportunities in some contrarian names that I can mention, but it means that you have to be a bit more mindful about where the risks are in the market.
You have a semiconductor idea for us. It trades on the TSX, 5N+. Remind us what it's very pure materials.
5N+ is a really interesting company based in Montreal. They really only have 3 global competitors, which are all based in China, but they are a manufacturer of specialty semiconductors as well as high-performance materials. Some of their customers are First Solar, as an example, in the U.S., building solar panels. They sell their products to companies that are putting satellites into high orbit, have several applications in medical imaging, pharmaceuticals, as well as some industrial purposes.
Let's have a look here. That stock's been rocking and rolling lately. I don't know if we've had them on BNN Bloomberg. We should get them on to talk about that business model. UPS now, is UPS a buy now, do you think?
We think that they've been a victim of some of the tariff uncertainty and pressures, some of the reduced consumer spending and consumer confidence among businesses as well. We think that they're a really interesting story. One of the big news items for them this year was the Amazon not using them as much for a third-party intermediary for deliveries, winding down volumes about 50% over the next year.
Was that, that was less profitable business, I think, for them,
we actually think it's an opportunity because the Amazon relationship has been highly dilutive to their profit margins. This allows them to be more oriented towards the U.S. domestically, some international markets, as well as healthcare, which is a growing profitability center for them.
And then finally, Pfizer, they have not come up, it seems, with a blockbuster diabetes/weight loss drug, and that's been something of a cloud for.
It's interesting because one of the concerns that investors have for that stock is the expiring of several successful patents over the next several years. We actually think that fundamentally they're a fantastic company and they have an excellent pipeline. Given a lot of the COVID cash that they accumulated, they're trading at only about an 8 times earnings today, yielding 7%. And I was on here a few weeks ago talking about another pharma company, and we think that that sector has been hit very hard given a lot of the Trump appointees, the pressure on U.S. drug prices, to bring them down more in line with international company or drug prices, as well as the general negativity towards vaccine skepticism and healthcare in general.
Yeah, look at the drop in Pfizer. Is it partly, though, they've been seen as missing out on the weight loss bonanza?
You could certainly say that, but I think there's still opportunities for them. They've got a good pipeline of several new drugs and immunotherapies that we feel can propel them for the next several years and support growth.
Because they bought a bunch of companies.
Yes, exactly. Yeah. I mentioned that COVID cash has been very helpful for them as they look to grow.